What is the yield curve? Why is it important?
So really just what we're looking at with a yield curve is a representation of yields for different bond maturities over time. And if you think about lending money for 1 year, there'll be a certain yield for that. If you think about lending money out for 30 years, there'll be another yield attached to that. And you plot these different bonds and their yields over time on a graph, and you end up with the yield curve. Now, in a normal curve environment, you'll have short bond yields, let's say they yield about 3%, and long bond yields will be yielding something higher because there's more risk in lending longer term. So yields might be something like 5%. Now, why I think it's important is because when we look at what is talked about in the media today, a lot of it focuses in on what the central banks are doing with their overnight rate, whether they're hiking or cutting rates. And that really directly impacts the short-term bond market, but it also indirectly or directly links to the long-term bonds as well, but there's other factors that go into long-term bond yields. So the yield curve will move up and down, and it could twist and invert in different ways. And I think it's very important to understand that there is different shifts in the yield curve. All bonds don't all move together.